Hey everybody, thank you for joining us. I am Rachel, the Customer Experience Online Sales and Marketing Manager here at Red Door Homes, and very excited to have Daniel McCoy with Intercoastal Mortgage. They are our partner preferred lender. Daniel, can you tell us just a little bit about yourself and how long you've been working with our homeowners?
Sure. My name is, as you said, Daniel McCoy. I'm the branch manager and senior loan officer for Intercoastal Mortgage. We've worked with Red Door for over 10 years now, so we've helped build a lot of beautiful homes throughout North and South Carolina with Red Door Homes, and we appreciate our relationship with Red Door, and it's been a great experience.
Absolutely, and I've actually personally worked with the McCoy team on 2 mortgages. I definitely recommend them. And we're here really just to talk about what's been on everybody's minds, Daniel, the changes in the market, the uncertainty. Is it a good time to buy? What can we expect? And so we've got some questions here that some of our future homeowners have been asking us that we were hoping we could get some expertise from you on today. The first question, Daniel, what are some pros and cons of a one-time versus a 2-time construction loan? And for those of you who don't know what that is, maybe first you can talk about what that means, and then what the pros and cons are of that type of loan that we use.
Sure. Yeah. So construction loans, usually the first question people will ask, is it a one-time close or a 2-time close? And a lot of times folks hear one-time close, and one-time closes do have advantages. Our program is technically a 2-time close, but I refer to it more as a split closing because the majority of the expense related to the loan is charged up front. And then the permanent loan closing is just to pay off the construction loan so that folks have their 30-year fixed mortgage that they ultimately want to have when they're living in the house. The benefit to our program compared to a lot of one-time close programs is it's extremely more flexible. Historically, construction loans that are one-time closes or just construction loans in general have been very restrictive. They may require 20% down. You have to have 740 credit scores sometimes. And that has been, a lot of times banks, that's the only program they offer. Our program opens up, all the different loan programs that you would have available to you if you were just purchasing an existing home, but allows us to do a construction loan with it. So what that means is we can do as little as 3.5% down on FHA loan, and land equity can count towards that. We can do 100% financing on a construction to permanent VA loan, as well as 5% down on a conventional loan. And those are loan to values that you will not find commonly with certainly one-time closes or really construction loan programs, anywhere. And the benefit to that is that, for folks who have land equity, they may not have to put any more money down. For folks who, haven't, the first-time home buyers who don't have proceeds coming from the sale of another home, they're not going to have a 20% down payment requirement, which is one of the benefits of our program. The knock on the 2-time close has always been the cost associated with it, but I've seen a lot of one-time close programs where the closing costs are much higher than what our programs are. And our program actually has reduced closing costs for folks who are putting 10% down, and then further reduced for folks who are putting 20% down. So the more down payment, the more equity you have in the project, then the less cost you're going to have. When we're dealing with those 95 to 100% loan to value construction loans, there's a little more risk to the bank. So there's going to be an upfront fee associated with those sorts of loans. But you can also wrap that into your contract with Red Door. We always advise customers when it makes sense to put an allowance for closing costs into the contract. And then there's also the credits provided for using us as a preferred lender. So the benefit of our program is primarily the flexibility, being able to use whatever type of loan program you would have available to you, versus meeting a very small box that most one-time close programs are. Also, a lot of one-time close loan programs are adjustable rate mortgages. Now we can do adjustable rate mortgages with our construction loan program. However, in recent years, we have not been in a market where you would want to consider adjustable rate mortgages because 30-year fixed rates have been lower than ARM rates in general.
Right, so, that's good to know. VA loans, FHA, conventional, all programs that people can take advantage of. And, as you were talking about some of the lower fees and different options, sounds like it could be really beneficial for some homeowners who are looking to kind of reduce costs when other costs are increasing
Right.
these days. So it sounds like there are, still a lot of benefits. Daniel, why is it important to choose a lender with a lot of construction loan experience? I personally know the answer to this, but maybe you can help share it for everyone for us.
Well, construction lending is it's just a different animal. It's a different process. Not a lot of lenders do it at all. Fewer do it well. And it's kind of like when you have your house built, you don't want somebody building your house that's doing it for the first time. You don't want to be someone's guinea pig. And we've seen more lenders step into construction lending over the last 10 years, and we've been doing it. We've done thousands of loans over the last 10 years that are construction projects. We've dealt with just about every scenario. But when you see new lenders come into the space, you're dealing with sales folks who, they want to be a part, they want to close your loan, or they want to be a part of it. But when things get tricky, or if there's something that's not perfect with that loan, you need somebody who has the experience to get it resolved and has the track record, because otherwise building a house is stressful as it is, even if it goes perfect. But when it doesn't go perfect, if you don't have someone who has the experience and can guide you through any sort of changes with cost or just anything in general, that you want somebody who has the experience. Just like when you're working with somebody who's building your home, the more times they've built a home, the more experience they have, the better they're going to be equipped to help you and make you avoid a big costly mistake. And that's what we try to be.
Yeah, one of the things we've seen, unfortunately, quite a lot in this market is just how important speed is, and specifically getting that construction loan closed. And so, we work with a lot of lenders, and what we find is when we work, or when our homeowners work with our preferred partner lenders, that process and experience for them goes a lot smoothly, but more importantly, we get their loan closed faster. And in today's market, that is absolutely critical. It's more important than it ever has been. So, if I could offer one piece of advice in a construction loan, it really would be, work with someone who has the experience to get your loan closed as quickly as possible. That will, could save you quite a bit of money, which today, for most people is pretty important. What are some of the economic factors that determine a change in consumer loan interest rates? We're hearing a lot about this these days, and a lot of the economic changes, but I don't think a lot of us really understand how that affects consumer loan interest rates.
Yeah, there's a lot of misconceptions out there. Certainly, we've been hearing a word we haven't heard in years, and that's inflation. And anytime there's inflationary pressures, that makes interest rates move up. There's also talks when there's inflation, that's when the Fed talks about raising what they're called the funds rate, which they are set to meet this month. And I think they've really told everybody, basically, they're going to raise the funds rate from 0 to 0.25%. Now, a lot of folks that we talk with, they'll say, well, we want to lock in a rate before, the Fed makes that announcement. But the market has already priced that in. That is already, the mortgage rates are not tied directly to the Fed funds rate, which is the rate that the Fed will be raising this month. Mortgage rates more closely follow the Treasury yields, 10-year Treasury yield to be specific. And so as you watch that yield go up or down, that's usually what mortgage rates will track with. And so over the last couple of years, we've seen some more inflation. I know, especially with gas prices, but gas prices being impacted by a lot of different variables right now. But we've seen inflation come in over the last few years because we've had, I think, a perfect storm of one, there's been a great demand for homes. I don't know if anybody, when we first were dealing with COVID and shutting down, if we knew that the housing market would be as busy and robust as it's been since March of 2020. And so you have that demand, and it's coupled with the impact on supply, both because of COVID and just the the supply chain being impacted by COVID, it has made a little bit of a perfect storm for prices coming up over the last few years. Now that's more reason to look at locking in price on their build sooner rather than later. A lot of times folks, I've had folks over the last few years who said, I'm going to wait till build costs come down. Unfortunately, when costs go up, they go up like a rocket. And when they come down much slowly, and they're more likely to level off at some point than they are to actually come down. Because as long as there's demand, it's supply and demand, the basics of economics. As long as there's demand, supply, the prices are going to stay where they are. They're not going to come down unless demand comes down significantly. And right now, the consumers are strong. There's the inflationary pressures on the income for consumers, but there has been wage growth over the last year, in the last couple of years, which we haven't seen either. So, the demand is not going to go anywhere. And as long as there's demand for new homes, which I don't see an end in sight with that, then prices are not likely to come back significantly. So, not to put pressure on people, but the sooner you do it, the sooner you lock in the price, the more likely that you're going to get a lower price than you would, 6 months from now or a year from now, because when they go up, they tend to stay up, or they continue to go up until something changes. And I don't think we're going to see a change in housing demand, certainly in our markets in North and South Carolina, real soon.
And I mean, the reality is, in our states, we're still actually priced pretty low and affordable compared to the rest of the country. So
yeah, we
work with room.
We work with a lot of folks who are coming from New York or California, and other markets where they come in here and they're like, this is still unbelievably cheap. And you tell that to folks like, I've lived in North Carolina my life, and it's hard to believe the price increases we've seen. But when you compare it to markets, Northern Virginia and these larger metropolitan markets, we're really in the lower, 40 or 50% of the home prices. Now that changes in North Carolina. You see, different markets within it, as well as South Carolina, but we are still, nationally very, very affordable.
Mm-hmm. Absolutely. And, I think everyone is kind of waiting for that balance of prices to come down. But the reality is really it's the interest rate that's going to make the biggest difference, because even if prices do come down, the interest rate goes up, 0.5%. That's still going to mean potentially a larger monthly mortgage payment. So maybe you can give us some context, I guess, as an example of what 0.5% per se, could mean on, I don't know if you have a number off the top of your head, but what that could look like monthly in just a small increment in an interest payment.
Yeah. So, interest rates, I know that rates have come up since last year. We had rates really dropped in 2020 and stayed low through 2021. And now they've come up, but they're still historically very low. They're around 4% on a 30-year fixed mortgage, which, for folks my parents' age and around that age, they remember rates that were in close to 20% in the late 70s, early 80s. So 4% is not as terrible as, it's just because the recent history, you kind of
comparing it to last year.
You're comparing it to last year, but you can't go back in time. I think that mortgage rates will level off this year as the Fed addresses inflation. And I think we're going to stay in a relatively tight window and still have low, competitive rates historically. And so that's something, of course, we all will watch closely. But for every $1,000 that you finance with rates where they are right now, it really only changes the payment by about $4 to $5 per month. And then when you look at rates, certainly, if rates were at 6%, then you're talking about a couple $100 difference a month in payment, potentially more depending on the size of the loan. And so those are the things you have to factor in when you're making that decision, especially if you're going to need a home soon, because the housing market, the way it is right now, there's just not a lot of inventory. And so building becomes a much more viable option for a lot of folks, because unless you're paying cash or you're, somebody or get lucky, then it's hard to even go under contract on a home right now with the housing market where it is and inventory being so low.
Yeah, I mean, absolutely. We've had so many homeowners come our way from that exact scenario. So I can't win on a home. It's winning is really what it is now. And
Yeah.
they're 6, 8, 10 months into 20 plus offers and no success. And so you start to look at other options and other avenues. And, we are still a very, affordable home builder, even in this market. So we've been blessed to be in the position that we are in this market. But still, it's something that not a lot of people are familiar with, and building on your land. Maybe you can just touch a little bit on, for those folks who don't own land, because we're seeing a lot more come our way these days just because of this market and people wanting to look at a different option, how that kind of works with construction loan, and just kind of explaining that we can kind of roll everything in together.
Yeah. The important thing for folks to know is that, the construction loan can be used to help purchase the land. So in those scenarios we talked about before, like an FHA loan with 3.5% down, or VA loan, 100% financing, those include the lot prices as well as lot preparation costs. The most important thing to know when you are using a construction loan to help purchase land is that you need to give yourself plenty of time on that land contract, because and that can be the tricky part in this market. But we're lending on the house and land together. We're not lending on one first and one later. We're lending on the package. And for us to be able to do a loan that is, smart, we have to verify that the value of the home that you're building, both the land and home together, it equals what you're paying for it, or at least close. And we lend based on the appraisal or the total cost, whichever is less. So if you're looking at land that's $50,000, you're building a $250,000 home, we want to ensure that home is worth $300,000, and it's difficult to appraise a house that doesn't exist yet. So we're going to rely heavily on the final floor plans and the final contract with Red Door, along with the lot contract, so the appraiser can look to see what you're building and then compare it to other homes nearby that are similar with square footage and acreage size in the lot, to determine that what's the market value. And that's what we lend based on, is the market value, what someone will pay for this home based on what folks have been paying for homes in that area. And so, the important things when you're buying land and you're incorporating the construction loan, one, I always recommend at least a 90-day contract on the land, just so you give yourself time to make selections, go through the design process with your dream home consultant. And so they can finalize the floor plans and finalize the contract. And you also may, need to do a perk test if you need to do septic system, or, and you want to give time for all those things, because everybody is taking longer in this market. The county is taking longer, the soil scientists are taking longer. So you want to give yourself time, because you don't want to be asking for an extension. And the other thing you want to look at as you're looking for land to put a home on is you want to see what homes are selling for around it. A lot of times we'll work with folks who are trying to build in very rural areas, and that's fine because Red Door builds in a very wide market. But you have to make sure that the price of what you're building is supported in that area, because there's some areas where there just hasn't been a lot of new construction. And there hasn't been a lot of recent sales because there's just not a lot of activity on the market. And we rely heavily, the appraiser relies heavily on what homes have sold for. And most places in North Carolina, there's been significant increases in appreciation and value to support even these increased costs of building. But you have to do your research, or if you're working with a realtor, make sure the realtor does the research on the location where you're building the home and what homes have sold for near it, because that is going to determine what we can lend. And certainly when we're at a higher loan to value, meaning for folks who aren't putting as much money down, that appraisal, is as important as anything, because we have to make sure that if you're borrowing 100%, that the home appraises for 100% of what you're paying for everything.
For sure. And on the flip side of that, if you own land, it's going to be the best possible time because the equity that you have in your land now, probably
Exactly.
quite a bit more than it has been. So if you needed, that little bit of wiggle room, you can probably get it in your equity of the land that you own. So for landowners, I mean, it really is an amazing time to decide, if you've been considering. We've seen that quite often recently. People who have visited with us maybe a year or two ago and just needed a little bit more in their budget, they've been able to get that and even more from the equity in their land, which is pretty amazing.
Yes, we work with a lot of folks who have land gifted to them by family, which is great. That land equity can cover your down payment, so you don't have to put any money into the transaction unless you want to. Or maybe even you get 20% equity because you got a decent amount of land, and you avoid private mortgage insurance on a conventional loan without having put anything down. And that's where it does help to have land already, whether it's being gifted to you or you've bought land previously, or a lot of times folks have a manufactured home on a property that they want to put a stick-built home on as their family has grown in size. That land equity can still serve to cover their down payment, or at least towards their down payment to reduce how much out of pocket they need to bring.
Absolutely. We've heard a lot about this kind of in the news and the media about this bubble. In your opinion, are we in a bubble?
I think a lot, because 2008 is so fresh in everyone's mind. I think everybody assumes economic, just changes and volatility means that the housing market is subject to, I talk with people all the time and say, we're worried that the housing market is going to deteriorate, or 6 months from now, a year from now. And I honestly can't see it happening anytime soon, because 2008 happened because a lot of lenders were doing bad loans, and so many homes got built because you could, if you had a pulse, you could get a mortgage. Now underwriting guidelines are not, they're at a good place as far as they're not too loose. And the demand for housing is so incredible that it will take every builder building every house they can to keep up for the foreseeable future. Yeah. And when you have a house that sells and one person got it, but 12 or 15 people were trying to get it, those 12 to 15 people still need it, are still looking for a home. So I think that the demand is going to be there for the foreseeable future. Now, it would take, I think, something drastic or something significant changing the what consumers are able to do. And right now, there's more jobs available than there are people to fill them. So I think there's going to be a strong consumer for the foreseeable future, and that is what will drive the housing market. So I don't believe we're going to see a housing bubble crash or anything like that, like we saw in 2008. I think that's just so fresh in our minds because of the impact it had on all of us. Certainly, I remember that's when I was relatively new to the industry, and I was like, well, what am I going to do now? And this is a completely different market. We're dealing with different issues from an economic standpoint, but housing demand is going to be there certainly in our market for the foreseeable future.
And we may see a slowdown. And I think even when we see a slowdown, people kind of panic. It's the same now with interest rates kind of going back to where they were. It's almost a panic, but it's really normalizing what has been since COVID, which actually, is a good thing. I don't think any of us really wanted to stay on the crazy housing path train that has been. It's crazy for people wanting to buy, want to build, people trying to get loans. Sure. So, I think the normalcy may feel a little bit off-putting, but I think it's actually stabilization is going to be good. And
I think it'll be good for all of us. Just sustainable. The last few years has been unlike any time that certainly I've witnessed, and I think my father's been in the business for 40 years. It's not unlike anything he'd ever seen. So I think that it won't be like it's been the last 2 years, but it's going to be steady and consistent. And there's still going to be, people looking for homes, and that's what ultimately is going to make the housing market sustainable and maintain, the need for homes.
Absolutely. Daniel, I appreciate you hopping on to have this kind of candid, transparent conversation with us. If people want to reach out to you with questions, how do they get a hold of you? What is the best email and phone number for you?
Yeah, well, the best phone number, I always give out my cell phone, which is 336-255-0445. You can also reach us on our office. I'm on the phone a lot. If you can't reach me, call the office at 336-378-0560. And then for inquiries, I do recommend using our team email, which is mccoyteam@icmtg.com. And we can share that as well. So everybody has it, but that's an inbox that everybody on our team has access to. So we make sure we get as quick a response to everybody as we can, because with the market being as crazy as it's been, I'm a lot of times in meetings or on phone calls with customers. And so that will get a much quicker response.
Yeah, I'll post your contact information in the comments. Daniel's information is also on our website as well. But thank you again so much for your time. This was really insightful. I think probably helpful to a lot of folks out there just really wondering what the heck is going on.
Yeah, no, it's volatility, and there's certainly a lot of things going on in the world that are bring all our collective blood pressure up. But I believe that the housing market is demand for housing is not going to change real soon. So that will be good.
Well, look forward to speaking with you again soon. You have a great day, and thanks
you.
everyone for joining us.
Take care.
Bye-bye.